Welcome everyone. Welcome to the KISS Investing 2020 first 6 months year in review. I'd like to dedicate this video to all my investors and to all my friends, and I hope you enjoy the content. I worked really hard to present some interesting ideas that I hope will help you in your investing decisions in the second half of the year. So without further ado, let's get started. First of all, the first 6 months of the year were truly unexpected. Nobody expected to have a virus attack the world and have such a huge impact. Also, nobody expected the market to go down so hard. The S&P went down all the way to 2250, and then it bounced over 40% with a rip off your face rally, going up more than 900 handles, which was really an unexpected comeback, especially after the Fed had intervened. For a few days nothing happened, and then all of a sudden the market realized what the Fed was doing, and the market just ripped higher. The world that we're living right now is changing, and it's changing very rapidly, and I don't think we're going to go back to the way we were for a long time. And if we only focus on the market, the market doesn't really tell us what's going on, because the market just been going up. The real world has much different and much bigger issues than the market is suffering right now. We will probably look to this time in our lives, the summer of 2020, as a big turning point, both in the markets and in our lives. The world won't come back like we knew it, but it could come back even better. And we must not make any assumptions of where the market is going based on what we think that the economy is going to face. There's a lot of social unrest also, with of course justified, because there's a lot of inequality in the world, and we're seeing a lot of riots and protests and demonstrations that will also affect the way governments make policy and the way the market reacts in the future. Of course, the Fed and all the capital institutions around the world, all the central bankers, including Japan, Asia, China, Europe, the European Central Bank, and the Fed, have all been very aggressive, creating a lot of liquidity, creating a lot of support for the markets, and in the hopes of stabilizing it. And what they have done, of course, they did stabilize the market, but also they have re-inflated the bubble in a very short period of time. Remember, this bubble was already showing signs of getting tired before COVID, and after COVID the Fed had no other choice but to act and inject a lot of liquidity. We've always thought that cash was a safe position in our portfolios, and maybe for the short term it still is, but because of the incredible amount of money printing that has been going on, cash, in my point of view, is no longer a safe part of your investment. Central bankers are debasing our currencies, and they're devaluing the value of the currency, and they're forcing us to move away from cash into real assets. And my only recommendation here would be to focus on cash generating assets, or assets of corporations that can raise prices without having the demand of their products being affected. So this is a big change that I see because of COVID, that cash is no longer a safe part of our portfolios. Now let's look at the indices. Year to date, the Nasdaq amazingly is up 17.5% for the first 6 months of the year, while the other three main indices are down. The S&P is down 3.5%, the Dow is down 9.5%, and the Russell, the weakest of the three, is 13% down for the year. Now, here's an interesting graph that I like to see. I prepare every month to see how bullish or bearish the year is going. As you can see, January, which is normally a very green month, was actually flat. And why was it flat? Because the market was realizing that the valuations of the market were very high and it couldn't go up much longer. Then, of course, February and March, we had huge hits to the market, having months 8% down, then 12% down. And then from March 23 on, we had a humongous 40% rally in the stock market. And we have not stopped. June, surprisingly, started down very weak. And then the Fed realized that the market could go down hard. And they came up with the great new idea to buy corporate debt, and which made the month of June green. I also like to see how the S&P is behaving, how strong or how weak the S&P. This year we've had already in the first 6 months, 2 months that the market has gone down more than 4%. We've had 1 month which was with a very small down move, and we had 1 month with a relatively small up move, and then we had 2 huge upticks in the market. And here we can see these are the averages. Normally the market has 4 to 5 months out of the year where it has a more than a 2% up move, and it has another 3 months where it has moves from 0 to 2% up. So in essence, we can see that 3/4 of the time the market is up in the months, and only 1/3 of the time the market is down. Now let's take a look at the sectors. Here, if you've been following my videos, here you can see that the technology sector has been practically the big winner and the only big winner so far this year. Technology is up 15% for the year. Then we have consumer discretionary products. It's up 3%, and the communication sector is down 3%. It's up 3%. Every other sector, healthcare, materials, consumer staples, real estate, utilities, industrials, down 15%, financials down 25%, and energy has been the ugly duckling, down 37%. This despite the huge up move we've had in oil since it went negative a few months ago in the futures expiration. Now let's take a look at the winners. It's been almost 12 years where we have seen 6 stocks dominate the stock market. These 6 stocks are Amazon, Netflix, Microsoft, Apple, Facebook, and Google. Just look at this year. Amazon is up 56%. Just in 2020. It's really amazing the power that the FANG stocks have. And that's the reason why technology is the only sector that's up huge for the year. But this market is getting a bit frothy and crazy and expensive. Just take a look at these statistics. The revenue for all the major car manufacturers in the world, General Motors, Ford, Fiat, Chrysler, Honda, Daimler, and Ferrari put together, they generate $731 billion of revenue, while Tesla only generates $26 billion of revenue. But if we look at the market cap, how much these companies are valued, we can see that Tesla now is worth more than all these incredible long-standing manufacturers. This type of behavior only happens in crazy asset markets that are in bubbling territory. We are in a level that is worrisome, and and we could have some surprises in the second half of the year. Now let's look at the ugly ducklings of the S&P 500. No surprise, Boeing, which was already having a lot of problems before with the 737 MAX, is down 44%, and it was much worse in March. Then we have ExxonMobil, again, energy, down for the year. JP Morgan, down 33%, again, financials. AT&T, which in everybody's mind, including mine, that has a very nice dividend and a nice yield, and you would think that people are using their cell phones now more than ever, is down 23%. Disney, despite having everything shut down, all the parks and everything, is down only 22%. Warren Buffett, the best investor of all times, is down 21%. And also another surprise, Coca-Cola is down 19% for the year. You would think that people are drinking a lot of soft drinks while they're staying at home. Now, let's look at the macro issues that we have for the second half of the year. What are the things that we should be looking at in order to make some investing decisions for the second half? First of all is COVID. COVID has the whole world upside down. Some people don't even believe it's true, some people don't care, and some people are truly paranoid and are just staying home and don't want to leave their houses and their security. The scientific community in the world is crazy looking for a vaccine. They're looking for a therapeutic, and everybody is working towards a solution to this problem. Now, what will happen with COVID in the fall? Will the virus accelerate and we could have more business contractions and disruptions, or will a cure and a vaccine come and we will finally get rid of this problem forever? The Fed, of course, has been injecting a lot of money into the markets. But one thing the Fed cannot do is generate sales. It cannot generate cash flows. It cannot generate profits for companies. That is one thing that has me worried, especially when companies start reporting profits for the second quarter, starting next week in July. Of course, everybody expects profits to be down, but with the market up so much, the expectations of a V-shaped recovery in cash flows and profits is also very high, and maybe we could see some disappointments. Of course, the FOMO, for those who don't follow this as closely as some crazy investors like I am, and a lot of you guys watching us, FOMO means fear of missing out. There's nothing worse for someone to see their neighbor getting rich and they're not getting rich. So when people see that the market is going up relentlessly, going up 40% in a short period of time, that brings in a lot of people back into the market and just pushes the prices up a lot more than they should be. One, in my point of view, positive thing about this COVID thing is the return of the retail investor. We have seen record number of accounts being opened at Robinhood and at other broker dealers like Doe, Tastyworks, etc. And there's a lot of interest from many people to get invested in the markets. Maybe it's because there's no betting in sports, maybe because there's nothing else to do but to look at the markets, but it doesn't matter what the reason is. What is very good is to have more people involved in the markets and more people raising their financial IQ. Of course, there are things that trouble me. For example, this gentleman, David Portnoy, he has been kind of a leader to the new retail investor crowd. He sits down, he makes videos, he bets on companies that are going bankrupt, on companies that are suffering like airlines and cruise ships, and they make huge bets, and they sometimes make huge profits, but they can also lose money. And I'm worried that we're going to lose some of these investors, newly created investors, when reality hits and we have a market pullback that these people have never seen, and of course they're not ready for. Another concerning thing are corporate profits and cash flows. Nobody really knows the permanent effect that COVID will have on companies' cash flows and demand. Right now, everything is rosy. We all think that demand is going to come 100% back. But what if it doesn't? What if it doesn't? What's going to happen to companies' profits? And ultimately, those profits affect the value of the companies. Multiple expansions. Since corporate profits have gone down tremendously and the stock market has gone up, the way we can justify this market move is 100% based on valuations. Imagine if a company was making $1 profit and the S&P was at $3,200, and now the company is making 50 cents, but we're back at 31.50 on the S&P. That means we're paying almost double and sometimes triple or more for the same cash flows that companies are generating. Of course, everybody says that valuations don't matter, that they're old-fashioned, and of course they don't matter now, but someday they will matter, and it's going to have a huge effect on companies' prices. Another interesting point is corporate debt. This recession was different than 2008. In 2008, it was mainly a over-leveraged position by banks. And this time, we have a big problem. We have never entered a recession with so much corporate debt, so much shit, so much bad debt being issued by companies, both good and bad. And that's why the Fed had to intervene in the corporate market debt and come and buy this junk, because really smart investors don't want any part of this debt that companies have accumulated. What happens when a company doesn't have the same amount of profits? Executives get paid. Normally, they get big bonuses if their share price goes up. And one way, a legal way that has been used by executives to get their company's price up, the stock price up, is to buy back their shares. Meaning the profits of a company get divided into a smaller number of shares, pumping up the earnings per share of that stock, ultimately pushing the price of the stock higher, and executives collecting huge bonuses. But when there's no money because there's no profits, what are they going to use to buy back stocks? Companies are already leveraged to the wazoo. They don't have any more room to generate more debt, and profits are hurting. So one of the biggest drivers of the stock market in the last 10 years have been buybacks, and I think buybacks are going to be extremely reduced in the future. Also, everybody is expecting a huge bounce on GDP. Here is the actual GDP print for the first quarter, -5. Then expectations for Q2 GDP are all the way from 40 to 50%. But everybody's expecting on Q3 to have a humongous bounce back, Q3 and Q4. And thus the reason why the market is higher, because everybody's expecting a V-shaped recovery both in GDP, earnings, and cash flows. One thing that could put a wrench in the Fed's plans is inflation. Of course, there's a lot of deflationary forces right now, like unemployment, lack of demand, etc. And that's why the Fed has been able to keep printing money right now. because those deflationary forces are acting to prevent inflation to coming up hard in the near future. What I believe that we're going to have humongous inflation coming up, and we're already seeing it in the commodities. The commodities are already signaling to us that inflation is coming. We can see gold going up very strong. We can see commodities starting to go back up, and we should keep an eye on those indicators, as the worst thing that could happen in an economy is have no growth and inflation. Everybody, once we reopen the economy, we can see the supply returning to the market. What do I mean with supply? That means restaurants are opening up, they have open tables. Airlines are opening up more flights, they have open seats. That's the supply part of the equation. Now, will the demand be there? Will people want to go back to their regular consumption habits? Will people start flying again like they did before? Will people go back to eating at restaurants like they did before? We don't know. We have to wait and see. But the market is pricing in as of like the demand returning to previous levels. Also, another caveat could be the presidential election. Candidate Joe Biden already said that he would roll back a lot of the tax rate cuts for individuals and corporations that President Trump had passed. And what effect will that have on the stock market if we kind of have reduced cash flows, reduced profits, and increased taxation? Of course, all that means bad news for stocks in the second half. Everybody's asking me, everybody's asking themselves, what's going to happen the second half of the year? Could we see a retest of the March lows? Or could the market ignore all the terrible fundamentals, all the terrible news, and continue going up, and go even higher than we are right now due to the Federal Reserve liquidity injections and driving this bubble up higher and higher and higher? Now, let's look at some themes I'm looking at very, very closely, and I am already investing in it for the second half in my own portfolio. I like 3 asset classes: gold, treasuries, and tips. Let's take a look what happened to these asset classes in the first half. Tips went up 6.5%. And for those who are not familiarized with tips are US treasuries that are linked to inflation. So if inflation goes up, these are very safe instruments because they're treasuries, but they're indexed to inflation. So we get the double benefit of being in treasuries and the benefit of having some inflation protection. We have seen that government bonds had a 9% return for the year, and gold has had a huge 17% rally, almost matching the Nasdaq. Everybody talks how strong the Nasdaq has been, but gold has been equally as strong in the market. So if you're afraid to buy the Nasdaq at these levels, gold could be a good alternative for you. Also, volatility, we started the year in the low teens. Then in March, we went to unprecedented levels of over 45% on the VIX. And with this huge rally that we've had, the VIX has been stubbornly high. Even last Friday, it closed at 27. As option traders, we would have killed to have 27 VIX before. Now 27 VIX to me and 24, 25 VIX, to me that's the low end of the new range. And I think we are in for a new regime of volatility. until there's a vaccine or there's a cure for the COVID. Now, let's take a look at some investing ideas that I have. Of course, these are not recommendations of any kind. These are just some ideas that I'm looking at to put in my own money in my own portfolio for the second half of the year. We have gold miners, already had a huge move, and bonds with the TLT, GLD, which is the gold ETF, and TIPS, which are the inflation protected treasuries. And here the next three, soybeans, utilities, and corn, these represent more of the commodity part of the market, and they're still down for the year. But as you can see, people are starting to realize that inflation is coming, and the last week they had huge up moves, and I think you're going to see more and more money go into commodities for the second half of the year as people try to get out of their cash and protect the buying power of their money. Here's another look to the instruments that I like and how they have performed. The only ones that are down are utilities, corn, and soybeans. Everything else is up, but I still think in any pullbacks we can get into a nice gold position and a nice tip position. Of course, right now they're a little higher, but I would be looking to add on any dips. If you're gonna buy the dip, I would buy the dip in gold and in tips, and also in any commodity that you can get your hands on. Here are some things I would like everybody to reflect on this weekend. Normally, the public is very risk averse, and normally investors are mostly bullish at market tops, and they're mostly bearish at market bottoms. Actually, it even happened to me. I've never been so bearish before as I was in March 23, and of course, that bearishness and that fear made me commit some trading and investing mistakes. Instead of going all in with my money, I covered some shorts and I covered some longs too early, hurting my position. Fear and greed are very, very, very strong things in people's minds. Don't underestimate them. But sometimes it's better to step back, breathe, and take a eagle's look at the market and see where we are. Right now, nobody's bearish, and that is a warning sign to me. And also important to keep in mind that markets that are very strong are very broad, meaning a lot of stocks are participating in it. This market move has been almost mainly in 5 or 6 stocks, the FANG stocks, the technology stocks. So markets that are very narrow, are only based on a few stocks, are very, very prone to risk and to have a huge down move. And I'd like to end with Jimmy Fallon saying that I love. And remember, guys, you gotta risk it to get the biscuit. Thank you very much for spending some of your holiday weekend with me, and I hope you enjoyed my first 6 months of the year review, and maybe you got some good ideas and suggestions or things to think about in order when you make your decisions for the second half. I appreciate you looking at this video. Remember, please, if you can, please click like. It helps me a lot. If you can write a nice comment, if you like the video, of course, that would help me a lot. And if you can, please subscribe to my channel. Thank you very much for your time. Good luck trading, and hope to see you soon in our video next week. Bye-bye.